TFSAs or RRSPs, you might be wondering which one is better for you. Well, the answer might surprise you. Keep watching to find out how the different tax treatments of each account can affect your financial planning. Hi, my name is Irene and I'm a CPA here in Canada. I post videos explaining important accounting and tax concepts using simple language to help Canadians better understand accounting and taxes. Make sure you hit that like and subscribe button for more. In Canada, both the TFSA and RRSP are tax-sheltered accounts. However, they work differently. A tax-free savings account, a TFSA, is a savings vehicle that allows your investments to grow tax-free. So you can contribute money into your tax-free savings account, your TFSA, and you'll take the cash within that account to buy investments such as stocks, ETFs, bonds, GICs, etc. Any investment income earned on those investments, such as interest, dividends, and capital gains, those will not be taxed. This is a very powerful tool because it allows your investments to grow tax-free. Each year, the government will set a contribution limit, and in 2023, the contribution limit is $6,500. If you do not contribute to the TFSA, your contribution room gets carried forward into the future years and it gets accumulated. So the program was introduced back in 2009, and assuming in 2009 you are of age to have the TFSA and you've never contributed $1 before, you will have a cumulative contribution room of $88,000. So if this is you, someone who never contributed and was of age in 2009, then you can contribute up to $88,000 in the current year, more than the $6,500 maximum, because you have that excess room that was carried forward from all of your past years. The contributions you make into your tax-free savings account is not tax deductible, meaning you cannot write that off on your personal tax return. However, the money that you withdraw from your TFSA, that money does not get taxed. You can withdraw your money anytime you want. All you need to do is sell the investments within your tax-free savings account and then withdraw the cash from that account. So any amounts that you withdraw in the current year, that will be added back into your contribution room in the following year. So let's say this year you take out $5,000 from your TFSA. Starting next January 1, that $5,000 will get added back into your contribution room in addition to the new maximum for the next year, which is going to be whatever, 6,000 XXX, depending on the year. So for the most part, your TFSA investments can grow tax-free. However, if you have, let's say, US dividends that you receive from US stocks that you hold within your TFSA, these US dividends, they're going to be subject to a 15% withholding taxes. That means whatever dividend you get, the US government is going to withhold 15% of that as part of the withholding taxes. Nonetheless, the TFSA is still a very powerful tool to help you grow your investments tax-free. The Registered Retirement Savings Plan, RRSP, is designed specifically for retirement savings. Similar to the idea of a TFSA, you can contribute money into the RRSP, and then you can use the cash within the RRSP to buy investments such as stocks, ETFs, mutual funds, bonds, GICs, etc. The investment income earned on those investments, such as interest, dividends, and capital gains, can grow tax-free until it is time for you to withdraw the money. When you withdraw money from your RRSP, the amounts withdrawn will get added onto your personal tax return to be taxed in the year you withdrew the money at your marginal tax rate. However, contributions made to the RRSP are tax deductible, meaning that you can deduct the amount you contributed into the RRSP off of your personal tax return in the year you contributed the money, which can lower your overall tax bill. So for example, assume you earned gross income of $100,000 and you contributed $18,000 into your RRSP during the year. Because RRSP contributions are tax deductible, now your taxable income is only going to be $82,000 rather than $100,000, which will lead to lower taxes for you in that year. The contribution room for RRSPs changes each year, and it depends on your earned income. In 2023, the contribution limit is 18% of your earned income for a maximum of $30,780. If you do not contribute to the RRSP, any unused contribution room will get carried forward into the future years. So unlike the TFSA, when you withdraw money from the RRSP, the amounts that you withdraw are not going to be added back into your contribution room in the following year, meaning that you would permanently lose the RRSP contribution room. The deadline to contribute to your RRSP for any given year is 60 days after the following year. It is important to consider your personal financial situation and goals when deciding between a TFSA and or a RRSP. The next section is not financial advice, but rather generalizations. Typically before retirement, you are in your prime earning years, in which you would have higher levels of income than compared to when you stop working upon retirement. Using an RRSP in this instance would be beneficial because you are allowed to deduct your RRSP contributions in the year that you have high levels of income because you are still working. And then upon retirement, when you are in a lower tax bracket, assuming that you have less income upon retirement because you stop working, then you can get taxed at a lower marginal tax rate when compared to when you are still working. On the other hand, TFSAs provide a bit more flexibility because if you need the money from the account earlier than expected, so before you actually retire, you are likely still going to be in a higher tax bracket because you're still working, assuming you're still working. These withdrawals that you take out from your TFSA, they're not going to be taxed. So even if you take it out during your prime earning years, you won't get taxed on those. So that is where the flexibility comes in. Please speak with a financial advisor to see which vehicle works best for you and your needs. Sometimes it could be a mixture of both, one or the other. It really depends on your unique situation. It's important to know your contribution room so that you don't over-contribute into these tax shelter registered accounts, because if you over-contribute, you will have a penalty. So to check your TFSA and RRSP contribution room, you can log on to the CRA website, and under the My Account Services portal, you can check your contribution room. This will give you information on how much you've contributed in the past and how much you have left remaining. However, it's really important to note that the CRA website is only ever updated January 1 for the RRSP and TFSA contribution rooms. So if you check your CRA online account for any transactions that happen during the current year, those will not be reflected within your CRA online portal. So you just have to make sure to track that yourself properly, because any activity in the current year will only be reflected in the next January 1. It's very easy to open up a TFSA or RRSP. You can either contact your bank like TD, CIBC, RBC, etc., or you can open up with a brokerage like Interactive Brokers. Once you have the account set up, you'll be able to see your account balances and transactions directly on the platform's website or app, just like any other bank account. It's really important to note that in order for the RRSP and TFSAs to work, you can't only deposit cash into these accounts. You have to deposit cash to buy investments. Or else if you only leave cash inside these accounts, it's no different than a checkings account at the bank. To open a TFSA, here in BC, the age is 18 years old, and you also need a valid SIN number. Both the TFSA and RRSP are considered registered accounts. And as for capital losses, assuming that you lost money on your investments due to, selling it at a lower proceeds than what you bought it for, these capital losses realized within your TFSA or RRSPs cannot be deducted on your personal tax return. If you already have a TFSA existing account with one institution and you want to move it to another institution, do not just withdraw the money out from the current institution and then contribute it into the other new institution because that's going to affect your contribution room. Instead, you should contact your current institution and you will fill out a form in which they will then release and transfer those funds into your new institution without affecting your TFSA contribution room. Both the RRSP and TFSA are great options when saving for retirement and saving in general. The contribution limits, the tax laws, and regulations are always changing, so make sure you're staying up to date before you invest. Thank you for watching until the very end. I hope it was helpful today. Over here, YouTube thinks that you're really going to like this video, so I'll meet you here.